The Federal Reserve just a few days ago increased interest rates yet again by 75 basis points or 0.75%, and this means one thing for asset prices. It means they are going to keep going down. Now, this is happening during a year where the Fed has already been steadily crashing the market for months on end, but as is so often the case, many investors are eternally optimistic and had convinced themselves that the pain was over, that all was okay, and there was nothing to worry about. The Fed, though, had other ideas, and this announcement that they just made in conjunction with what Jerome Powell actually said put this idea to bed once more. Investors are panicking, they don't know why this keeps happening to them, and unfortunately, it's only going to get worse. In this video, we're going to explain everything that happened, what it means for the markets, for asset prices as a whole, your investments, and what we should be doing about this. So what actually just happened? Well, the Federal Open Market Committee sat, and it's made up of the board of the Federal Reserve, who are the people that actually decide how high interest rates should be. Unsurprisingly to anyone who has looked at the data, the committee came to the conclusion that interest rates needed to be raised by 75 basis points or 0.75%. This comes after months and months of previous interest rate hikes that now mean the federal funds rate, or the base rate as some people know it, is now set at 3.75% to 4%, but most people just say 3.75. This interest rate that they set then goes on to affect the interest rates of all variable rate debt and any new debt in the United States, so this directly impacts the American people. Do you have credit card debt? Well, this decision by the Fed and Jerome Powell just made that debt more expensive. Do you have a mortgage on a variable rate, or are you looking to buy a home in the future? Well, that monthly repayment that you'll have to make just got more expensive. Car loans, student loans, HELOCs, pretty much any form of debt you can think of just got more expensive in the United States. Now, with interest rates sitting at 3.75%, they are the highest America has seen since before the 2008 financial crisis, but this isn't everything that happened. These kind of decisions are not made in a vacuum, and we do always get some words from none other than Jerome Powell himself to tell us why he's taken this action. Now, in total, he spoke for about 45 minutes, so I'm not going to bore you with everything that was said, but these are a few of the things that he said that are very important. The first important thing that Powell said was about future interest rate hikes, as this will determine how much more expensive we see debt become in the future. As we come closer to that level and move further into restrictive territory, the question of speed becomes less important, and that's why I've said at the last two press conferences that at some point it will be important to slow the pace of increases. So that time is coming, and it may come as soon as the next meeting or the one after that, but no decision has yet been made. Now, Powell is talking about what's coming next, and we can draw two direct conclusions from that quote. The first is that over recent months, we've seen the Federal Reserve hike interest rates by 75 basis points, which is quite a large step to increase it by. Earlier on in the year, they were hiking by 50 or even 25 basis points, so at a much slower rate. Powell made it clear that now the groundwork for fighting inflation has been set, it's no longer such an urgent issue, and they don't need to maintain extremely large interest rate hikes to break the back of inflation. That means at some point in the future, maybe the next month, maybe a bit further down the line, we are going to see smaller rate hikes that are less damaging to the markets and the economy. The second thing we can tell from this statement is that even though the size of these hikes will likely reduce soon enough, the hikes themselves will keep coming, so interest rates will continue to rise, just at a slower pace. The next important thing that Powell said was specifically about the Fed pivot, or the idea that at some point the Fed will change its mind, stop raising interest rates altogether, and actually start lowering them again. It is very premature to be thinking about pausing. People, when they hear lags, think about a pause. It is very premature, in my view, to think about or to be talking about pausing our rate hikes. We have a ways to go. So here, it's very clear that Powell will not direct a Fed pivot anytime soon. Tighter monetary policy is here to stay until inflation is well and truly struck down, and there is no evidence to suggest that we are currently anywhere near that stage. This is very bad news for the markets, and this is the main thing that caused them to go into haywire during this speech. For the last couple of weeks, investors had been betting and hoping that the Fed pivot was finally here, that stocks would stop getting hammered, and they would finally start another bull run, but all of those investors were wrong. This comment all but confirms we are in for many more months of very tough market conditions, where stock prices fall, where earnings fall, and investors lose money day by day and week by week. Finally then, Powell also spoke about the idea of a soft landing, whereby the Federal Reserve is able to hike interest rates to curb inflation without causing a recession in the process. The opposite of this, a hard landing, is where the Fed does manage to curb inflation, but it comes at the cost of a recession. Now, this will come as no surprise to regular watchers of the channel because we've been saying this for over a year now, but the prospect of a soft landing is already incredibly low, and it just keeps getting lower and lower, and sadly, that is exactly what Jerome Powell just said as well. We've always said it was going to be difficult, but to the extent rates have to go higher and stay higher for longer, it becomes harder to see the path. It's narrowed. I would say the path has narrowed over the course of the last year. This all but guarantees a real and significant recession for the American economy as the cost of bringing inflation down to bear. This is mostly bad news, but it was inevitable in my view, and there is also a silver lining. The fact that Powell is recognizing that he will likely cause a recession by fighting inflation means he is very unlikely to balk when really bad data starts to come through, and this, in my opinion, increases the likelihood that Jerome Powell will see this mission to its end and well and truly kill inflation. What does this mean for all of us? Well, as people, citizens and employees, students, business owners and retirees, it means times are going to get tough for a while. Inflation is still high, but it will eventually be brought down to acceptable levels by the Federal Reserve's actions, and in the long run, this is for the best. Unfortunately, this will come at the cost of a recession that is actually quite likely to be a major one. That means businesses will go under, people will lose their jobs, some will even lose their homes. This is not a good thing, but it is the result of our previous greed. Next time a government convinces you that there's such a thing as a magic money tree, look back to 2022 and the years that will follow, and remember that these politicians do not have your best interests at heart. The only reason we are in this situation right now today is because of our government's irresponsible and short-sighted policy decisions to print trillions of dollars and shower our economy in cash in the wake of the COVID pandemic. We as normal people ought to learn our lessons from this and ensure it doesn't happen again. As for us as investors, this means asset prices are going to continue to fall, and this is both good and bad. If you own assets, you will lose money, but you will also be granted an opportunity to invest at rock bottom levels, and if you play your cards right over the next few years, you could even make your fortune. So what should we all do about this? Well, we should be cautious. We should prepare for a tough few years, save some cash up, dial back our monthly outgoings where we can, and forego some of our beloved luxuries. We need to keep an eye on the markets, pay attention to inflation data and the data about the US economy as a whole, because that much desired Federal Reserve pivot will eventually come, even if it does take a year or even longer to finally emerge. But when it comes, that will most likely be the best signal we will ever get to invest back into the markets, as the monetary environment will begin to loosen and lax once more. Businesses will be able to cheaply invest in their futures, and employment figures along with salaries will once again grow. With that will come the next bull market, the time when stocks and shares start to rise instead of fall each week, and we can go back to the standard tried and true method of simply saving a bit of money each month and investing what we can afford into the markets, confident that in the long run it will all play out as expected. Now, on one final note, I think fundamentally what a lot of people miss when talking about the Fed, about what they're currently doing, is that this is the right idea that they're going with, and it is backed up by historical precedent. Let's not forget that back in early 2022, we were all chastising the Fed for not actually going far enough, for not actually caring about inflation, and just hoping that it would sort itself out all on its own. That of course never happened, and it was never going to happen either. We now have a Fed fundamentally dedicated to fighting inflation, which is imperative to the functioning of this economy in the long run. Without this shift that we have now seen, the United States, and by proxy, pretty much every other Western nation in the world, would have been doomed to an inflation spiral that no one could control. The Fed being separate from the rest of the government means that when Biden wants the markets to rise before an election cycle so his pals can stay in power, well, he can't make that kind of decision regarding monetary policy. Instead, we now have a figure like Jerome Powell who knows very well that if he fails to get a grip on inflation, his legacy will be one of cowardice and failure, and he seems more determined than ever to ensure that isn't what he leaves behind. To those who insist on trying to predict the eventual Federal Reserve pivot, yes, you will eventually be right, but in waiting and trying to time that moment, you are going to continually lose money month after month and week after week. Until we see inflation curbed and cut down to the 2% a month figure that we want to see, the Fed is going to keep tightening monetary policy and the markets are going to keep falling as well. Betting against that right now is a loser's bet, and as the entirety of 2022 has well and truly proven, it's not going to go well for you.